So of the different types of tax shelters that you have, some of these are net, they will all help you save on tax. Some of these can help you save on tax differently. And some of these can help you save on tax while still being able to allow you to have liquidity if you need it. So when we look at our types of tax vehicles like self-directed IRAs, solo 401ks, and defined benefit plans, what we're really trying to do here is say we have a dollar threshold that we're trying to meet. I want to protect all of that money from tax. And at the same time, what I'm trying to do is to say, I'm not really worried about cash flow off of that. I'm not using those dollars to be able to accomplish a financial freedom objective or to otherwise be able to access any of that capital. I'm really using it as essentially as a long-term net worth play, a quasi type of insurance policy for my retirement. Nothing wrong with using retirement accounts. I find that typically retirement accounts are best used after you accomplish all of your cash flow objectives that you're going to need to be able to live the lifestyle that you want. And it really just turns into a place of the heck with it. I don't need more cash flow. What I really want is just to save the money on the tax and sock it away. Now, there is an option that exists for you called it's a 501c nonprofit or a private foundation. So of 501c3 entities, there are two different types. What we're going to focus on here is the private foundation type that individuals can own. They wholly control what happens inside of the foundation, and they can directly manage all of the investments that are located inside of that foundation. Now, what's amazing about private foundations is if, let's say, you had $200,000 in income, and that private foundation then can take up to 30% of your top line revenue, so up to $60,000. Now, if you had $1 million in revenue and income, that could be $300,000. And then once the money's inside of the private foundation, you're able to invest it. You can invest it in just about anything that you want to. All of the money that is earned is essentially tax-free. And then it builds in a way like a super IRA or a super solo 401k. The benefit of a private foundation is it also allows for liquidity. So if you wanted to tap into your retirement accounts, you end up having to pay penalties. If you wanted to withdraw money from your private foundation, you are a director of that foundation, so you can pay yourself a wage of the wage that you pay. At that moment, it then becomes taxable income, but there's no penalties associated with it. And so a lot of people really like this private foundation as another part of their strategy because it allows liquidity, because they can use it as an IRA if it was just a pure retirement account. And you don't really lose anything for sheltering your money, right? It's either you pay tax on it this year, or if you need money on it in the future, you're just paying tax on it then. But in an ideal situation, it just works as a retirement account that has liquidity, but doesn't without penalty, without being locked up until retirement. And so this is the game that your CPA or your CFO should be playing with you, and it should all be on spreadsheets, right? So if your current CPA and your current CFO is not modeling out, here's the types of tax vehicles that we can be using, to be able, and here's the types of investments that we need to make, the exact dollar amount that you need to place, and this type of investment that has these types of returns, net worth, cash flow, and tax benefit returns. Then sorry to say that what you're really doing is you're shooting in the dark with how you're building your company. Pretend for a second, that you're the CEO of this company and this company is building wealth, and that you had investors in this company. And these investors in this company want targets, right? So what I'm offering to you is the concept is that you should be setting your own targets. You should be setting the targets of like, here's actually what I really want to be hitting between this year and next year for my cash flow. This is the target I want to be hitting with my net worth. This is the target that I need to hit in terms of tax benefits from my investments that I make to get my taxes as close to zero as possible. And then work backwards with high level professionals that are using spreadsheets and crunching numbers to be able to tell you, great, you did a great job, Jason, at bringing in this amount of money into the company. And now here's exactly how much money you need to place in each one of these different types of deals to hit the types of targets that you set for yourself. Or if you're, if you want to play the game of CEO of the wealth building company, what you'd say is, these are the of adequately hitting the targets of the investors that were in your company, but you're just an investor of one. So what's the net impact of having these types of things put together? And it's that it's ultimate clarity. You're never thinking and wondering anymore about what it is that I need to do to get to the place that I need to get to, because you actually have to slow down to think about where exactly am I trying to get to, and what time frame am I trying to get there, and then how am I going to know from actually having to sit down with a professional that's an expert and has tools available to them to crunch through these numbers so I can answer the one critical question that almost nobody knows the answer to that I ever talked to, which is, do you know exactly how much money you need to place in your next investment, and what are the cash flow, net worth, and tax benefits associated with that investment?